Canada's latest GDP number showed our economy contracted by 0.2% in February. That was led by declines in mining, oil, and gas. For more on this, let's go to Dawn Desjardins. She's the chief economist at Deloitte Canada. Joins us in-house now to talk some more about this. Thanks for coming in.
Oh, my pleasure.
What is your read on this? Are we beginning now to see the effects of the trade war?
Well, I think there was a lot going on in February that impacted the numbers. But even when we look at the preliminary estimate for March, that's only a gain of 0.1. So I think we are starting to see the impact. And the impact really because we've seen so many indications that Canadian businesses and Canadian consumers are pretty tense right now.
Yeah. So if we're seeing that contraction, and they talked about a little bit of a bounce back in March, how do you square that?
Well, I mean, it was a lot of factors that depressed it, I think, that are going to reverse in March. But still, that increase is not very much. And when you think about what did we see in March and other data, jobs declined in the month. So I think it is, while we started off strong in January, it's been a slow slide down, and we think we're going to continue to see weakening in the economy as we go through the next couple quarters.
Okay, so let's talk about resources. We always presume that, our resources are well received by the world. Everybody needs us, but we took a hit early on in resources. Why do you think, was that the 10% tariff that went on, or was that something else?
I think it's a combination of prices coming off as well. Regardless of what the tariffs are aimed to do, we are seeing weakening in the U.S. economy. So again, softening in demand. I think when we look forward, that is another factor that we have to consider when we think about, well, how's the economy going to evolve? So we know that we, right now, have the carve-out for any of the goods that we send south of the border that are CUSMA compliant. And, the energy sector in there. But the thing is, if we're sending into a softening economy, yes, it's not elevating the prices with the tariffs, but we are still selling into a market that's slowing and slower demand for our exports.
And everybody's tightening their wallets. Okay, so let's talk about manufacturing also being up. Was that just the idea that manufacturers are trying to get ahead, push up their inventories across the border, and so that's going to disappear?
Well, that's it. And we even saw that in the U.S. GDP number that we got today. It showed that imports were up 41% annualized. You have to double take that. Is it 4.1? No, it's 41, because everyone was trying to get ahead of these tariffs. So we manufactured more, we exported more, the U.S. imported more, and that impacted their numbers.
How badly could that be hit in the next set of numbers?
Well, I think we could see we'll see some declines, I think, because even if we aren't directly, we know steel and aluminum are tariffed. Autos, they are, and they aren't, and they are. So we know that this uncertainty is also causing a lot of businesses, I think, on both sides of the border to really examine how much they want to demand. And I think that's going to be part of that story, that we're going to see demand weaken for our exports, and similarly for Canadian companies who are saying, well, I'm not really sure that I want to put money to work right now. We're going to see them also pulling back, so importing a little less too.
Yeah, a lot of stalls. Okay, let's talk about how you see this affecting inflation and how soon.
Well, inflation, I mean, it is going to be, I think, up a bit, but we don't have it going well above the 3% target. I think perhaps what's more important for central bank policy is inflation expectations. So we have started to see some increase in those expectations, because once consumers expect inflation, and we've just gone through it, we know what that's like, it does stay higher for longer if people expect inflation to keep rising and they demand higher wages. So we have the rate topping out near the 3% mark, gradually increasing, because we too have some tariffs on some of the goods we're importing. Our Canadian dollar has weakened a bit. But we also have to, I think, put into that equation the fact that we do have slack in our economy. So that too, and commodity prices aren't performing quite as strongly as they may otherwise would have been.
Okay, so does Canada have some sort of area to tuck in for productivity here? Is there some sort of advantage we can take?
Well, I think as long as we retain our CUSMA carve-outs, that may open the opportunity for some Canadian exports, if we assume the reciprocal tariffs remain in place in all these other countries, there may be a little bit of room for us to pick up some market share. But we also need more investment. And that is going to be slow coming, I think, because we are still operating under such huge uncertainty. I mean, it's only a natural impulse to kind of draw back. So what do we need to get this to a stage where companies are saying, okay, I see the opportunity now. Maybe it's across Canada, maybe it's into other markets, but we need a little bit of assurance. And I think that's going to only come once we have a clear picture of what the ultimate goal is for the U.S. administration and when we can kind of get back to whatever the new normal looks like.
Do we get a little bit of a benefit now that the uncertainty of the election is over? We now have a new prime minister, old prime minister, who's going to sort of try and take the trade war head on and try and deal with that. How helpful is that?
Well, I think it can be helpful. We'll have to see how it evolves.
Sure.
You know, but certainly having a government in place, a government that will be able to look to programs that they want to put in place that should help our productivity, whatever that looks like, whether they're looking at infrastructure spending. Again, nothing happens very quickly, as we can imagine, but just knowing that we are investing, that we are, in fact, trying to clear up so we can become a more efficient, more productive economy, I think that will give Canadian companies a bit of a spark.
Something else that will likely take a long time, but we know the government's looking into is diversification of trade, right?
Yeah.
How much stock do you put into getting rid of the interprovincial barriers and how much that could help, but there's a hard push for that. And how much energy do we need to put into diversifying trade outside of the U.S.? Because some are saying the U.S. is right there. It might not be, a good partner right now, but it doesn't mean it won't be a better partner later. So where do you divide that?
Well, I think from the interprovincial trade barriers, we've looked at it, and it does add to GDP. And so it seems a bit like that's a made in Canada, so let's really tackle that. That should be, I think, our first dual line, yes.
Yeah.
And then in terms of diversification, we have had in place free trade agreements, I think 15 of them, with 1.6 billion potential customers. We may have to lean a little harder into that, but again, we need the infrastructure. So it's a partnership. We need to see both the investment, and then I think we can see us growing all of our relationships because we are a little bit shaken by what's happened recently.
I'd say very, very shaken, actually, by what's happened. Dawn, thanks for coming in. Appreciate your time.
Oh, thank you.
Dawn is the chief economist at Deloitte Canada.